24th of January 2023, the Hindenburg report launched a direct against the Adani Group, and it caused havoc in the Indian capital markets. And like we saw, this had such an insane impact on the Adani stocks that 7 Adani companies lost more than $100 billion in market cap. And ever since this report has come out, the entire Indian public has been segregated into two extreme categories. So while on one side, people believed the reports blindly and started bashing the Adani Group for pulling off a fraud. On the other side, people dismiss the Hindenburg report itself and label it as a direct attack on the Indian economy. Let's start from the basics and understand why is Hindenburg bothered about Adani so much, and what do they gain from this information war. Well, as it turns out, Hindenburg is a financial research company that looks to find self-created or man-made issues and uses a method called short selling to make a profit by the fall of a company's stock prices. So, regardless of whether these allegations are true or not, if the fear mongering causes the stock to crash, which it did, Hindenburg would make a hefty profit. But just because they are short selling, we cannot just ignore the Hindenburg report without actually reading it and understanding it. So let's just deep dive into it and understand the Hindenburg allegations and Adani's response to the same. Now, we all know that Adani, who had a net worth of roughly $120 billion, he had gotten most of his wealth in the last 3 years. At the end of 2019, his net worth was around $20 billion, but the rest $100 billion got accumulated in the past 3 years itself. And this, according to Hindenburg, is largely through the appreciation of his stock prices in the group's 7 key listed companies. If you see in the last 3 years itself, Adani Enterprises stock price had shot up by 1,398%. Adani Gas shot up by 2,121%, and Adani Green shot up by 908%. So the question is, how Adani companies accumulate so much wealth and what is the secret of their growth? Apart from their cutting-edge execution, one very critical factor for their growth is depth strategy. This entire complexity is a permutation and combination of two moves. That is, using one group company's loan eligibility to pass it on to another group company, and lastly, to direct cash flow to a troubled group company. This master plan of cash flow created a virtuous cycle of Adanis, whereby when an Adani company wants to contest for a tender, they were able to. After raising funds, they bag huge infra projects, and once they do, every single news channel media houses start screaming out of the progress of Adani's. This in turn boosts investor confidence and more people invest in Adani stock. So again, when the stock prices of these companies goes up, they are able to pledge the value of those stocks to get even bigger loans, which again helps them back giant government projects. Now, is this risky? Absolutely. It's very risky because it could lead to a vicious cycle whereby if the share value drops, the bank could sell the shares. But when such huge volume of shares are released, the investor sentiment could go negative and could cause a stock to crash and would further lead to more selling. This is why the Hindenburg report says equity share pledge are an inherently unstable source of lending collateral, because if the share price drops, the lender can make a collateral call. If no additional collateral is available, the lender could require a forced liquidation of shares, often perpetuating a self-fulfilling cycle or as stock prices move lower and selling continues. Secondly, they also points out something called the current ratio of the Adani Group. For those who don't know, current ratio is financial indicator that measures the company's ability to pay its short-term obligations. It's basically calculated by dividing company's current assets by current liabilities. Let's start with current. Hindenburg reports points out that Adani Groups, whereby they started, the 5 out of 7 in Adani's companies have current ratio of less than 1. In fact, the current ratio of Adani Group and total gas stand at 0.5 and 2. Yes, it's risky, but is it wrong? Absolutely not. So if this is very clear to you, let's look at Adani's response to this allegation. To counter the allegation regarding their debt, the group said that the growth of their EBITDA or profit before tax is 2 times the growth of debt over the last 5 years. So while profits have grown at 22%, which is total debt of the company minus its cash has grown to smaller pace of 11% annually in the last decade. So even though the value of debt is high, the debt to profit ratio has actually decreased over time. While most people think Adani is sinking in debt in the past 3 years, it's actually the complete opposite of it. In fact, the group has come out of debt very rapidly in the past 3 years. In fact, 3 out of 6 Adani companies are only in moderate risk phase, and one of them is in low risk. one of them is at high risk and the green is at very high risk. But because they have a huge houses of companies to balance it out, if we look at their total net debt to R beta, it is slightly above moderate risk category. So you can see the risk which share pledging has actually been reduced in the past 3 years and not increased. So this is the both side of the story, and it's up to you to decide if this is right, wrong, risky or safe. Thank you.